Good morning, everybody, and thank you very much for having us in today's Frostrow webinar. I'm very excited about presenting to you today the Mobius Investment Trust. As you will remember, this is a highly differentiated emerging market investment trust, differentiated by way of its concentration, by way of combining rigorous stock selection with engagement with every portfolio company. And we are really excited about the fact that we are now just about to reach our third year anniversary. We're reaching our 3-year track record, and we're moving into this with very good performance over the last 3 years almost, very strong results from our portfolio companies. And I'm very happy to report that both stock selection and engagement are the two drivers of performance of the Mobius Investment Trust. But let's talk about some of the details. I'm going to go through the attribution analysis. I will cover some of the details of the strategy. We'll talk about India. We'll talk about Taiwan. Let's dive into this. First of all, performance. Since inception, the trust has delivered very strong performance. As I mentioned, performance since inception now in NAV terms is 30% over the last year. Actually, since March 2020, the NAV performance is 66.2%, share price up 75%. And also year to date, we continue to see very positive results coming through as we're moving out of the COVID environment in most of the markets. So that leads to a strong recovery in share prices and very strong results. And therefore, we expect this momentum to continue for the rest of this year. If you really look at the main drivers of the performance of the Mobius Investment Trust, we will show here the 5 top holdings, and they have a couple of commonalities which are worth mentioning. First of all, these are companies which are run by highly incentivized management teams that have built a particular strength in a particular segment, which make them a leader in a niche or in a broader segment. They have developed very strong brands. They have done this without overly extending their balance sheet by way of taking on too much leverage. Actually, they have very prudent and conservative capital structures, and they're margin leaders, they're profitability leaders. Now, as a group of companies, if you look at the total composition of the portfolio, it is far more concentrated than what you see, for example, in our peer group in the UK market. So we're typically trying to invest in about 25 to 30 companies, and we really try to invest in them, which means we also work very closely with management, with boards, with other stakeholders to ensure that they're well run, to ensure that minority shareholder interests are protected, and to ensure that their governance and transparency improve over time. Now, the active share of the strategy is well above 95%. I have so far not seen any other fund in our space that can offer this, which means we truly select without any guidance by the index. We truly select these opportunities because of the fundamental conviction. It's an unconstrained strategy. Of course, there is a focus on medium-sized enterprises right now because we see that this is a space which is not so well understood, where there is little coverage, where there's thin ownership in many cases, and you really can discover opportunities which are unique and mispriced, which is really important. We also look at smaller companies, we look at larger companies, and we are flexible about this, but the core focus is on this mid-cap segment. I mentioned the customized engagement, and maybe just to say a few more words on this. Sometimes the engagement is lighter in nature. It may mean that we suggest that a company hires a new IR team. It may mean that they improve the reporting, whether it's the quarterly reporting or the annual reports that they disclose. And in other cases, it's more deeper dialogues that we are conducting It may mean that we are suggesting to sell non-core businesses. It may mean that we are suggesting to improve the composition and the quality of the board, which we have done. We've actually done this already in a number of cases. And the most important thing is that it's all based on a constructive and positive dialogue with the companies. As a result of our very independent stock selection process, you will also see later on that the strategy looks significantly different in terms of the sector weights and in terms of the country weights compared to peer group or the MSCI mid-cap index. But let's take a very quick look at those holdings here. E-memory technology. This is a business, when we started to purchase this, it was less than $1 billion in market cap. And what we really liked here is the management, the incentive system, the motivation of senior decision makers to make this business a success, the uniqueness of their research and development, their reputation and close relationship with the likes of TSMC, which they're supplying their IC design to, their very close relationships with the end clients, diversified end clients, and their product, at the end of the day, their product and profitability, which is absolutely phenomenal. And they go from strength to strength. It's a group of very, very skilled engineers that constantly come up with new solutions. They are focusing on embedded non-volatile memory and many encryption-focused technologies which are used in electronic devices. Persistent Systems, a leader in software consulting, catering to the industrial clients as well as clients in the medical arena. And again, they are a leader. They have recently introduced a new incentive system for their sales group. They've got a very driven CEO, and it's a strong, well-regarded, very reputable and profitable business that is growing very quickly around the world. Again, very diversified in Europe and the US, operating out of India, but really being exposed to the whole world. So these are two examples of our 5 top holdings, but they can all be characterized by those factors. And again, brand, profitability leaders, conservative balance sheet, real leadership in terms of thinking, and the fact that they can attract some of the best people in emerging markets, some of the most talented staff, is another important factor. If you just take a quick look at the country analysis, the country breakdown of the strategy, yes, India remains one of the main focus areas. We remain very excited about the long-term prospects of India. It is blessed by a very vibrant entrepreneurial group of innovators, of corporate leaders, and they are increasingly helped by a more benign and helpful government, which is trying to debottleneck infrastructure, which is trying to attract FDI, which is trying to support businesses to become not just regional or local leaders, but global leaders. So India continues to be our focus, followed by Taiwan, where we are finding a lot of medium-sized tech names, Brazil at 12%, China, where we have about 15%. And again, the main focus here is on identifying the opportunities on the ground, and the result of this is the current country weights. If you just want to spend a few more moments with me on India, there are different realities in India, and we are trying to focus and work very closely with our network in India in order to find out what's really going on and whether the long-term prospects are going to be derailed by the current COVID-19 crisis. And our finding is that, first of all, the government is reacting very efficiently. They are rolling out vaccinations very aggressively and successfully. The recovery rates are moving up rapidly, now far above 85%. Most of the trouble is really contained to some densely populated urban centers. But in India, you have more than 1.3 billion people, and the vast majority continue to conduct a relatively normal life. And actually, we're now seeing that the numbers are improving again, and we think that very soon this will be a fact of the past. As you can see here, our stock selection in India has done very well. Only this year, APL Apollo, Polycab, Persistent Systems, Metropolis have outperformed the Nifty 50 significantly, and we continue to see that there's many reasons why one can be bullish on those businesses longer term. India is going to lead the world in terms of growth in a post-COVID-19 environment, and of course, this is based on many factors and a lot of actually migration that's taking place, industrial migration from other Asian countries into India, supported by lots of government initiatives which make it easier for foreigners to invest in India. But all of this will lead to a solid growth in India. If we look at Taiwan, we also continue to be very positive about Taiwan long term. The businesses in Taiwan are profitability leaders. If you look at ROAs and ROEs in Taiwan, this is very difficult to find anywhere else in the world. And also the earnings expectations in Taiwan are set to improve over the next 12, 24 months. So there's good momentum here as transparency is improving and as the Taiwanese economy is normalizing as well, and the supply chain related problems will normalize over the next 2 years. They have dealt incredibly effectively with COVID-19. They kept cases very low. It's a country which is blessed by a very strong currency. They have a very large current account surplus, which is supportive. They have no external borrowings. And again, they are expected to grow very rapidly. Our exposure in Taiwan, again, has done very well. eMemory up 263% since we held this from early 2018. Elite Material, Win Semiconductors, Sinwin Electronics, Parade Technologies. The entire exposure here has done really well. Elite Material recently a little bit weaker, but we see this as a very strong opportunity to add further to this position, which we gradually built up. Now, as a result of our work, the sector breakdown looks as follows. IT is 38%. This is the largest exposure, and please be reminded that this is very differentiated to the Tencent, Alibaba, Baidu, Samsung ecosystem. We are focusing on smaller businesses, of which many can become very large businesses in the future. Healthcare is another very important area for us, 15%, building this out even further. We think emerging markets will invest more into healthcare, domestic healthcare service providers, and we think that the investments into this space will lead to very solid results going forward. Similarly, consumer discretionary, where we're excited about, but again, we are shifting more towards domestic producers as opposed to kind of regional global producers. Now, just a few words on technology in general, what we are seeing. It's obvious that we are in the middle of a revolution that's taking place. The digital world is seeing another boost, helped by the COVID or supported by the COVID crisis, from digital communication, 5G, Wi-Fi 6. We're seeing a lot of new innovations that are now accelerating very quickly. Large data centers, lots of investments in those. E-commerce, another very important area. Factory automation, autonomous driving, and many of these areas, many of these industries get a lot of their components and products from emerging market producers. And we actually look at three main areas here. One is the global semiconductor industry. The other one is global e-commerce, then software. And out of these three, we actually have 38% right now in software versus 58% in semiconductors and 4% in e-commerce. And the group of our investment has had a positive contribution of 25% since we started this fund. This will be a large part of our investment also over the next years, as we are seeing more and more exciting business models which are maturing, which are being listed, and which are highly exciting for investors that have the ability to invest also in smaller businesses in the end. Now, we talk about engagement. We're just showing you a brief case study here. This is eMemory, one of our largest holdings, actually the largest holding currently. It's a silicon IP company based in Taiwan. And what we're trying to show here is just the number of interactions that we have with businesses. Even during COVID-19, we had very regular exchanges with them. We focused with them on employee share option schemes to improve those and introduce them. We worked with them very hard on improving their presentation material. This is a business which is fantastic in what they do in terms of their core competency. They are not so great, or they were not so great in terms of their ability to communicate this to the investor world. And the IR functions and quality was not up to speed. And they were very, very open and actually happy that we helped them to improve this. We also work with them on a non-deal roadshow in Europe to attract more long-term shareholders. And we are currently working with them on ESG improvements, the reporting that's associated with this. They recently done a culture survey, which we do with every company. And we recently had a very pleasing meeting with the president of the company via Zoom. So it's a constant interaction. Coming to the performance, as I said, we are up 30% since inception. The discount is narrowing. We're working hard on ensuring that the trust can eventually trade at a premium so we can grow it. That's the ultimate goal. And if you look at the outperformance against the MSCI Emerging Market Mid-Cap Index, we have now over 14% in relative outperformance against the benchmark, which is making this trust actually the best performing in its peer group. As you can see here, also year to date, we continue to leave the peer group behind. We're right on top with the peer group average returning 3.9% and our performance about 12.5%. The top 10 holdings make up 60% of the portfolio. Very concentrated exposure here across the top names. And as you see, the sweet spot is around 2 to 3 billion market cap, well diversified across technology, industrials, consumer discretionary, and healthcare, and simultaneously also well diversified across countries with Taiwan, India, China, Korea, Kenya, Brazil, among the top 10 holdings. We've got the first frontier name here, Safaricom, which is really doing well. It's a technology business in Africa. And we continue to also look for quality names in frontier markets. Almost none of these holdings have any significant weight in the index. Actually, none of them have a significant weight. There's just a few basis points here in YAM and AK, but that's a tiny little overlap we have here. In terms of the portfolio characteristics, I'm just going to point out maybe 2 or 3 points here. One is I talked about profitability leaders. ROE and ROAs are very high and significantly higher than what we are seeing in the universe. Market cap somewhere between 2 and 4 billion is our sweet spot. Profit margins definitely higher than the MSCI EM mid cap, also higher than the MSCI Emerging Market Index. And then very importantly, prudent, conservative balance sheets. We've got a super strong team, which is helping us to execute the strategy. They're all very passionate about what we do. This is the core investment team we're showing here. But of course, we are also getting a lot of help from global members of our global network, which we have developed over the last decade. So we work with colleagues in Brazil, in China, in Taiwan, and Turkey. But we also have local language expertise in India. Zwathi is based in Mumbai. Also, our Chinese colleague, Zheng Yang, is often spending time in China. Of course, she speaks Mandarin, so that's helpful. Max doing a great job, focusing currently on Asia as well. And Usman is driving the engagement work, among many other things. But we think we've got a really focused, highly motivated, and skillful team in place to execute this strategy successfully. We also want to differentiate ourselves by offering a readable, a fun, a useful fact sheet, which goes right into the most important areas and covers the improvements that we observe among portfolio companies, also the weaknesses which we still need to address. And we actually registered esg+c.com as the website. I suggest you can take a look at this. This is something we're building out. We're enjoying this very much. And that's a connection between our work, our portfolio companies, and our investors. Thank you very much for your attention. I would like to reiterate that we are so pleased to reach our 3rd year anniversary. And thank you very much for your support and your interest. I look forward to the Q&A later on.
Thank you, Carlos, for that presentation, and thank you for joining us from Istanbul Airport. You look very dapper there in your jacket. We've got a few questions for you. The first of which is on Africa. You mentioned Safaricom there. What countries continue to excite the team, or sector? Any specific sectors that continue to excite you within Africa?
Thank you, David. Yes, Africa has always been an area which we are very interested in and passionate about. As you remember, we invested, many hundreds of millions of dollars in Africa over the past 15, 20 years. It's a region of many halves in a way. I would say there's a big part of the old world, of course, lots of resource-related companies in South Africa and West Sub-Saharan Africa, which we are less interested in. But there's also an enormous degree of innovation and entrepreneurial activity, which we are seeing, especially in East Africa. There has recently been a significant deal announced, actually just 2 days ago, where Safaricom, with a big consortium, got the permit to acquire a large asset in Ethiopia. So the technology is certainly one of the top areas we're interested in. There are more and more listed businesses, locally and international businesses, which give us access to the technology part. E-commerce plays a big role, but then also, of course, consumer-related businesses. We have Clicks in South Africa, which is a leading pharmacy chain, now also rolling out the model into the rest of the continent. So anything consumer, but we're actually trying to play it very, very safe. There's also lots of macroeconomic risks. Many countries are boom and bust, too much related still, or too much dependent on oil prices, commodity prices. So you have to play it very carefully.
Thank you. A question on China here. Can you elaborate on your holding in Yum China, particularly why you were choosing to play the middle-class consumer theme with Yum's suite of international brands ahead of a local domestic name?
That's a very good question. We actually had done a lot of work on the space, and we looked at companies like Haidilao, Lao, which you can actually also enjoy in the center of London, which is a very successful hot pot chain. We also looked at many other of the local franchises before we arrived at Yum. The reason why we have a preference for Yum is because there's superior reporting, superior transparency, very, very talented management team. It's actually one of the best management teams we can find in Asia, with a phenomenal track record. And then also the cash generation. The business is generating about $1 billion a year in free cash flow, which they reinvest in the business. They're gradually moving into franchising going forward. So also that will have a big positive impact on profitability. But it's really the quality and the people which made us decide to invest in this and not in the others.
Thank you. What reliance does the investment team place on Mark Mobius, and how is his key man risk managed?
Well, Mark Mobius is going to outlive all of us. You can rest assured. He's in top shape. He's very involved in emerging markets. He's doing a lot of work. He's also still working as a board member of various committees of the World Bank. He's currently actually residing out of Dubai. Mark is really an incredible positive force in emerging markets, allowing helping us and facilitating our access to decision makers, policy makers, entrepreneurial families. We are looking forward to working with Mark for a long time. But of course, also we have a very strong investment team that's supporting us. And we think we've got the right resources, the right recipe in place to make this trust a long-term success.
Thanks, Carlos. This is, of course, a large mandate from a geographical perspective. How do you screen and identify such a broad universe of companies?
That's a good question. And it's we are using alternative sources in order to find ideas. And we've really moved away from some of those old-fashioned ways that the investment or buy side, how the buy side operated in the past. We've moved to a much more concentrated team. We are much more focused on certain themes, on certain type of companies in emerging markets. So we are not investing in state-owned enterprises. We are not investing in the large resource business. We are not investing in any businesses like the gigantic banks, which are obviously very exposed to regulatory risk, but really going down to the more entrepreneurial part of the segment. And the sourcing is using alternative channels, as I mentioned. One is our local network, which we developed since 1987. And that network is very powerful. And it's in all of the emerging markets. I'm calling here from Turkey today. I just met with very senior business people here in Turkey, with members of the business community. And you find out a lot of what's really going on. There are, in fact, lots of IPOs coming to the market. There's, again, a very ambiguous situation here with what we read abroad and what's happening really in the country. And then we are also doing a technical screening, market by market, where we screen for a wide range of quality factors in order to narrow down our universe to those companies which we think are best qualified and the best fit to the family of portfolio companies in our strategy.
Thanks, Carlos. And I've probably just time for one more question. As you're in Turkey, could you just give us a bit of an update on the situation on the ground there?
Yes, it's been a couple of very, very exciting days here. I was not so sure if I could really make it. I got lots of warnings about traveling here. Having arrived in Turkey and having spent the last couple of days here, I can tell you that, again, the situation on the ground looks different to what you're sometimes reading abroad. The government is making every effort to get the COVID-19 crisis under control. The country has been hit incredibly hard by the last year. Of course, it is one of the most open economies in emerging markets, so they depend on trade. They've grown as fast as China over the last couple of years. And so the past 12, 18 months hit them right at the core. But the Turks are very strong. They are used to dealing with volatility. Of course, the macroeconomic situation continues to hurt, but I can see here that shops are beginning to open up. Social distancing is practiced with a great degree of discipline. The Chinese vaccination is offered, and the vaccination rates are going up. And it is a great example of a country that continues to see pressure on the currency, on its current account, on its trade account. However, there is a very talented and very driven group of local entrepreneurs. We've invested in two businesses, Logo, which is a leading software business, which has done very well over the last 12 to 18 months. They actually gained market share. And it turned out to be a very good recipe to invest in businesses that had lots of cash and liquid balance sheets, because they are the ones which will come out stronger out of this crisis. The second one is Mavi, the fashion retailer. And again, just this morning, I was checking some of their stores, and business is coming back. And again, they've been very prudent in running the business and managing costs. And they are expanding into other geographies, so they're doing quite well. So if you search, and if you are very careful, you can find very good businesses even in difficult countries like Turkey.
Well, good afternoon. My name is Eric Levinson, Head of Business Development here at VinaCapital, and I'm joined by Andy Ho, Chief Investment Officer of VinaCapital, and Michael Kokolari, our Chief Economist. And this afternoon, we're going to introduce the VOF, Vietnam Opportunity Fund, to the group here. We're going to have 20 minutes of kind of a conversation here, and then we'll go to question and answer for about 10 minutes. So thank you so much for joining us. Andy, you know, some folks on the line may be familiar with VinaCapital, but there's probably some people that are not. Kind of introduce VinaCapital to the audience.
Thanks, Eric. Yes, VinaCapital, we've been around since 2003. Today we manage about $3.5 billion of capital, half of which is in the traditional asset management space, like public equity and fixed income. The other half is in what we call the alternative asset space, including venture capital, energy, as well as VOF, which focuses primarily on private equity types of investment.
Interesting. Now your story is also unique. You're Viet Q. You can explain what that means to the group. You work with Michael Dell at Dell Ventures. You have an MBA from MIT, which is probably unique here in Vietnam. What's your story? How long have you been in Vietnam, and why did you come here?
Yeah, thanks, Eric. Viet Q is a terminology meant for folks that have spent most of their lives outside the country, which I have. I've spent most of my life in the United States, and as well as Don Lam, the CEO. He's spent most of his life in Canada as well, and we've been enamored by Vietnam, its growth story. I came back in 2004, so that's been over 15 years, and I think the growth has been tremendous. And I think the next 15 years will be even better. Being that I am Vietnamese, with the experience and the background that I have, it made a lot of sense for both Don and myself to be part of the Vietnam story.
Yeah, and in fact, so your experience is unique, and I just learned, as we talked about during the prep, you're also now a published author. And what is your book about?
Yeah, I've been asked to share some thoughts as to how to make successful investments in Vietnam. The name of the book is called Crossing the Street. It will be published any day now, okay. And through the folks in London, Harriman's publishing house. And so the idea is to share with the audience and share with the readers what are the challenges of investing in Vietnam, and how do you navigate some of these challenges to make successful investments out of it.
Interesting. So hopefully we'll cover some of that stuff in the next 20 minutes. And so as you think about VOF, VOF is a London-listed portfolio, a FTSE 250 company, has a very unique approach. You talk about having a private equity approach to public equities. What exactly do you mean by that?
Yeah, I think what the approach that VOF executes in terms of investment allows us to deploy large amounts of money. Today, anywhere between $30 to $40 to $50 million at a time. We're able to have much higher visibility into the business because we ask to have due diligence rights into the business, whether the financials, legal, or ESG. We also ask for investment terms, mostly minority protections, terms that allow us to participate at the board level or at the managerial level. And most importantly, terms to commit the sponsor to taking the company either public over the next 3 to 5 years, or through a trade sales in the coming years. So effectively what we do is we take a private investment approach to companies that we believe can either go public in a 3 to 5 year time frame, such as Hoa Phat, that's one of the largest steel companies in Vietnam. Us taking some of these companies to a trade sale, which we sold a large vodka company to Diageo not too long ago.
Interesting. So let me turn it over to Michael. We'll come back to you, Andy, as the portfolio manager. So Michael, you've been working in Asia for over 20 years, been an economist in Vietnam for over 10 years. Now Vietnam, for those of you who are familiar with the story, has managed COVID extremely well. Vietnam actually had positive GDP growth last year of a little over 2%. What does the economy look like today, and what are you forecasting for the next kind of 12 to 24 months?
Yeah, we're having another really strong year here. I'm expecting GDP growth of 6.5%, maybe a bit more than 6.5%, and it's not because of base effects, because as you mentioned, last year was relatively strong. There's really two key drivers that are supporting the economy, and the first is the consumption, because as you just mentioned, the government has really handled COVID very well without impeding the economy. So consumption is growing at almost double-digit pace this year, which is, amazing, and again, not based on base effects. And then the other thing is that Vietnam is manufacturing and exporting a lot of products that have become to be known as so-called stay-at-home goods, so things that people need to work and stay at home. televisions, laptops, things of this nature.
You know, so another thing that people were talking about last year, and maybe talk about if it's a longer lasting impact, is this whole China plus one strategy, or looking at their supply chains. And is Vietnam a beneficiary from FDI companies diversifying their manufacturing base?
Yeah, this has been, the story had actually started already a few years ago with the trade war, and then the COVID really accelerated it. Vietnam's exports to the US this year are up, so far up 50% as part of this story. But probably the more interesting, important aspect of this is the build out of local supply chains to supply those FDI companies. And I think this is going to be the story in this country for probably the next 10 years.
Yeah. You know, and one last question for you is that, you know, when people look in Vietnam as a frontier market, you know, one of the questions tends to be, what about the currency? And so that can be, and has been historically, an issue. You know, what's your view on the Vietnamese dong in kind of the past and the future?
Sure. Well, probably a lot of the viewers will know that in 2015 there was a lot of turbulence with the Chinese currency and Asia in general, and at that time the Vietnamese authorities really put a lot of macroprudential regulations and things of this nature in place that have really been very effective to stabilize the currency throughout the COVID and everything. But because the trade surplus is so huge, because there's so much investment flows coming into the country every year, I actually expect that we'll start appreciating by about 2 to 3% annually going forward for probably the next 5, 6, 7 years.
Yeah, and so the last couple of years, it's actually been quite stable
Very
as well.
stable, yeah.
And now you actually think you'll see some growth.
That's right, yeah.
Interesting. So Andy, back to you. You mentioned Hua Fat, but I think, you know, the people want to say, okay, so, you know, we had a positive GDP growth last year. Michael's suggesting kind of 6.5%, maybe 7% in 2021. What does that mean for the portfolio? What are you looking at today with that as a foundation?
Yeah, I think Mike's right. We do expect a very strong growth in the economy in the next 3 to 5 years. And that means a few things for us. One is our strategy in terms of looking for great companies has not changed. The sectors that we focus on has not changed. And the sectors we focus on are primarily those that benefit from the growth of the domestic economy. With GDP growing 6 or 7% per annum, it means the people are getting wealthier and wealthier. That means they're going to spend money on consumer goods, financial products, education, healthcare, the basic sectors that benefit from the growth of the domestic economy. And further to that, because of the trade war with China, we are seeing a lot of FDI, of multinationals, migrate some of their manufacturing base to Vietnam, which this is great for the logistics space, infrastructure space as well. So that's some additional assets that we may look into as far as investing is concerned.
Yeah, and so in Vietnam, you know, people talk about kind of these big demographic trends. It's a country with roughly 97 million people, 2/3 under 35, and then an urbanization rate, people leaving kind of the suburbs or rural community into the cities at about 37% a year. So as you think about those as the demographic trends, are there any specific deals that you're looking at or you've closed recently that kind of express your investment philosophy?
Sure. Recently, we closed $40 million investments into the largest primary real estate primary brokerage business in Vietnam. The market value is about $500 million. It's a private deal. We hope the company will go public sometime later this year. It is a reflection of the fact that we believe the individuals are getting wealthier. The GDP per capita is around $2,500 to $3,500 per annum. These folks will need to buy homes. This company is the largest primary broker in Vietnam. They help real estate developers sell the apartments to individuals that are looking for homes. And these individuals are buying homes in the outer skirts of the city, and these folks are the largest player in this space.
Yeah, and it's interesting that the numbers, the 2,500 to 3,500, it's actually much higher than that in the cities. And then interestingly enough, that kind of $3,500 GDP per capita has historically been when kind of consumption has taken off in other frontier and emerging markets. You know, also I think $40 million at a 500 million multiple kind of is also kind of, when we talk about your philosophy, you tend to want significant but minority stakes. Do you agree with that as well?
That's right. We are taking a significant minority stake in this business. We do have terms of investments with the sponsor and the business as well. and we have a high level of visibility into the board activity as well as the management's activities of the business as well.
Okay. Now, we talk about the fund having a private equity approach to public equity. Earlier in the conversation, you mentioned Hua Fat, which is a public company, but a lot of people may not know if they look at the fact sheet. It's the number one holding, but they may not know the whole story about when you invested. So maybe walk us through the investment in Hua Fat, how long ago you bought it, why you still own it, and kind of that journey as a representative of looking at how the team manages money.
Yeah, Hua Fat's a great case study for VOF and VinaCapital in general. We invested in this business about late 2007, early 2008 timeframe. We put about $50 million into this steel company. They were importing scrap metals, and they were buzzing it down and creating construction steel out of it. Our investment allowed them to invest in a fully integrated steel complex, which means that they were producing steel. They would be producing steel from iron and coke. And as a result of our investment, they were able to do a fully integrated steel complex and produce steel at a significant discount to their competitors, those that were importing scrap metal. So at the time, we invested in the business. It was slightly less than $500 million in value. Today, Hua Fat is the largest steel company in Vietnam. It is expected to deliver over $1.2 billion in profit after tax this year. That's a growth of over 100% in EPS growth for 2021. They recently introduced total capacity of 8 million tons per annum in 2020. That's why they're able to deliver such a high level of profit for 2021. Their market cap is $9 billion in value. Remember, we invested when it's less than $500 million in value. Today it's $9 billion in value. And it is a company that's producing products and goods that caters to the spending of the government, infrastructure spending, as well as the spending by property developers building up buildings so that individuals who are getting wealthier and wealthier can buy apartments. Yeah. So it's a play on the growing economy as well as a play on the fact that the government wants to spend a lot of money on developing and investing on the infrastructure of Vietnam.
Yeah, and I think as we think about it, it's also a credit to their management. It's not simply about a rise in commodity prices or even a rise in just demand. I think when you entered the company, it was the 11th largest steel company. Yes. It's now the largest. So it went from 11th to first. It's not like every other company had the same trajectory. So as much as it's getting the beta right, you still have to pick the right company.
That's right. And the key was understanding the barriers of entry. Yeah. For those that were producing steel. And the barriers of entry was a large investment, but a very determined group of leaders who want to produce steel from A to Z through a fully integrated steel complex. That is not an easy endeavor. Not only does it require capital, but it requires a significant amount of technical skills to be able to do it on a large scale.
Yeah. Now, to give the audience maybe a feel for just the way the portfolio looks, I think I don't want to say it's easy to talk about Hua Fat, but it's certainly a great story. Owned it for 14 years. Maybe give another example of another company that's maybe been in the portfolio for a while in kind of the journey, because not every journey is that successful, but it's still successful.
Yeah, we've been very fortunate. The economy has been growing well. Most of our investments have been quite successful. Another example is the largest jewelry company in Vietnam called P&J. We invested when they were private, and subsequent to our investment, they've gone public. Today, they are the largest jewelry company on the stock market today. As you can see, the theme of our investment is that we would take private investments. We would take a private equity approach or an investment into these private businesses before they go public, and help them to grow to the next phase and take them public, and then hold them in our portfolio as a public entity. So some people look at it, well, VOF has 60-70% exposed to the public equity market. Is it really a private equity fund? It is, because our entry into these businesses are private equity. We take large stakes and we have high visibility around the business as well as its management. So over the years, we've been able to take P&J onto the market, and this year, I'm hoping this year, P&J will cross the $1 billion market cap mark. We're very proud to say that we've been part of at least 20 companies that crossed the $1 billion market cap mark over the last 10 years. And Hua Fat will be the second company in Vietnam to deliver over $1 billion of profit after tax.
Nice.
Okay, so this year we hope the largest jewelry company will cross the $1 billion mark. Earlier this year, our investment in OCB Bank, what we made about 3 years ago, crossed the $1 billion mark. They listed on the stock market early part of this year and crossed the $1 billion mark.
Interesting. And so as we think about what the portfolio looks like, I think, maybe like you addressed two things. One, do we have a competitive advantage? Because there are other portfolios that invest in Vietnam by firms that are based in Singapore or Hong Kong or other places. What is the advantage to being in Vietnam? And then the second part is, how many deals do you look at versus how many deals do you invest in? And I think for any private equity investor, that's always interesting.
Sure. I think Vietnam's opened up right now. So most folks from around the region or even the United States or Europe have access to Vietnam. And we have folks like KKR, TPG here, Warburg Pincus here. They're all partnering with us to do investments in Vietnam. So our unique strength in Vietnam is that we are Vietnamese. I am Vietnamese, Don's Vietnamese. We are having that conversation with the chairman and the CEOs of the companies, the raw conversation as to what are the challenges and how to grow the business. How do we help each other grow the next 5 to 10 years? And so I think that's our unique advantage. And I have to admit, a lot of folks, particularly in the leadership echelon, are still very weak at English. And so it requires folks like us that can navigate and be able to communicate well with them and appreciate their challenges in running the business. Yeah. I think that's one of our unique selling points.
Yeah. And then in terms of deal flow, how many do you look at versus how many do you invest in?
Oh, each year we can look at anywhere between 100 to 200 opportunities. And we probably have about a 5% hit rate on the average when we look at these businesses. As time goes by, you can appreciate that these businesses are getting bigger and bigger. The opportunities are getting bigger as well. And so it also takes a lot more time to understand these businesses as we work with the Big Four to understand the financial side, the lawyers, and understand the legal side. So it takes time, it takes resources. So our investment rate is probably around 5%.
Interesting. Now, Michael, let me turn it back to you here. So as we think about the economy, we've got domestic consumption, we've got foreign direct investment. Are there any other themes that you see playing out in 2021 in terms of helping Vietnam with this continued growth?
Well, one of the things that Andy had alluded to is that the government is really pushing infrastructure development. Last year, infrastructure development grew by about 35%, and it's around 6% of GDP. That obviously helps our steel investment. But in terms of allowing FDI to keep coming in the years going forward, the build out of the infrastructure and the logistics industry, this is really going to be fabulous for the country, I think.
Yeah, no. And as we think about the GDP growth, and if certainly those of us here, we're reading all the time what different folks are saying, but maybe people aren't as Vietnam focused as we are, your projection for that 6.5-7% GDP growth, that doesn't include a rebound in tourism.
That's right.
And so maybe mention how big tourism was as a percent of GDP and why that's relevant.
Yeah. Well, prior to COVID, foreign tourism was around 8% of GDP. Domestic tourism was around 4%. Now, obviously foreign tourism has kind of completely evaporated. We think it probably is not going to come back for maybe another year and a half, 2 years. But what has happened is that the domestic tourism has actually taken up some of the slack, so it's made up some of the difference.
Interesting. Yeah, so our view is that tourism doesn't need to recover in order for Vietnam to continue with its strength. And Andy, last question for you before we open it up for questions. So the stock market was up last year in Vietnam about 15%. Year to date, it's up almost 15 or about 15 plus or minus. For people that haven't invested in Vietnam, did they miss it? What's the outlook? And kind of think about the valuations in the fund versus the valuations in the market, which I would suggest are actually still pretty attractive.
Yeah, I think Vietnam has still 10 to 15, at least 10 to 15 years of potential in the coming to go. Our valuation is relatively inexpensive compared to the region. We're trading at about 15 times forward PE for 2021. That's still a discount to the regional, roughly 10 to 20% discount. What's great about what's happening now is the liquidity, the daily trading average, the daily trading volume, if you will, in Vietnam has gone to almost $1 billion a day. About a year ago, we would be trading at about 150 to 250 million dollars a day. As you can see, the domestic participants as well as international participants have brought the trading volume up significantly, creating a lot of liquidity for the market. So now is a time where you can enter a market that's fairly liquid, that has potential to grow in the coming years on the back of a GDP growth about 6 to 7% and valuations that's relatively inexpensive. So factors are there to help investors pick and choose good companies in Vietnam to grow in the next few years.
Yeah, thank you. And you know, the other thing I would share, and because some clients had brought this up with us, is that the appreciation of the stock market has actually been driven by earnings growth as opposed to simply PE expansion. Yes. And then the second part, if people look at the markets, we only have 1.5% of the market is actually technology. And so while a lot of the market, you look at what's going on in China, you look at what's going on in the US, is really driven by, you know, whether it's FANG stocks or the like, here it's traditional, it's commodities, materials, it's financials in a big way. And so the actual makeup of the market is actually different. And so it's not just being driven by kind of hot tech money, so it's diversifying in that way. Well, that's I think our wrap on 20 minutes, and now we're going to turn it over to live Q&A. So we'll just wait for the first question. Thank you.
Thank you again to the team there. We're now joined in Ho Chi Minh City by left to right here, Mike Kokolari, who's the chief economist at VinaCapital, Andy Ho in the middle, who's the CIO, and Eric Levinson on the far right of your screens, who's the head of business development. I've just got a couple of questions for the team. The first of which is, what is the current COVID situation on the ground in Vietnam, and how is it impacting the investment outlook?
Yeah, thanks, David. At the moment, we recently had a recent outbreak, but it's not that bad. The situation is that we have less than 5,000 cases of COVID in Vietnam from the beginning until now. We've had less than 40 deaths. Most of the cases have occurred inside what we call government quarantine facilities, so they're not really in the community. But the government has taken a lot of caution. They have restricted movements in Hanoi for the moment. But that's generally it. They're being very cautious. As for the stock market and the rest of the economy, the stock market continues to do very, very well. But as you can imagine, some of the businesses, particularly in the service provision space or hospitality space, they have had to restrict a lot of their activities, particularly restaurants, have had to reduce the seating arrangement to maximum 20 people. And as a result, a lot of the businesses have slowed down because of the cautiousness that the government is taking at the moment. But in general, the market's very strong. It's trading at around $1 billion a day at the moment, 4 or 5 times that level 1 to 2 years ago. And so I think a lot of domestic investors are very excited about the stock market and have participated in a very large amount over the last few months.
Thanks, Andy. And on that front, private equity, where are you seeing opportunities?
Yeah, the private equity side, as you know, we define it quite broadly, but it is opportunities where we have the right to do due diligence. We negotiate terms of investments, minority protections, performance commitment, etc. And most importantly, we get to participate at the board level and the manager level to help the business grow. Applying this type of thinking, we are seeing quite a bit of opportunities. The size of the opportunities have gotten a lot bigger. As you know, late 2020, in December 2020, we deployed $90 million into a private equity investment. And so the opportunities we're seeing in the next 6 to 12 months is exciting. And as you also know, we are quite discriminate in terms of choosing the investment that we want to invest in, and particularly around management, our ability to trust management to deliver the business, the plan, and the strategy in the coming 3 to 5 years.
Thank you. Another question here: how is a more assertive China likely to impact Vietnam's growth opportunities over the medium term?
Mike?
Well, this is a topic that was covered. There's a very influential think tank in Washington, D.C. Called the Atlantic Council. Anyone that's interested in this topic, I'd really urge you to download. They have a 100-page strategy report giving advice to the U.S. government about this topic. Long story short, it really is in the U.S. interest now to help foster and bolster Vietnam's economic development, as well as the development of a few other countries in this region. And we really see clear evidence already that is the strategy that the U.S. is taking. U.S. is Vietnam's largest export market. Our exports to the U.S. are up already 50% this year. So basically what's happening is this is sort of pushing the U.S. and Vietnam closer together, which will definitely help foster our economic future development going into the future.
Thanks, Mike. Are all the major drivers of Vietnam's growth intact? FDI investment, demographics, middle class growth, etc.
I would say they're even more intact than what people realize. The story is still there. Last year, Vietnam's FDI inflows didn't budge at all. FDI in the world was down 40% last year. Ours didn't change at all, still 7% of GDP. Everything with demographics, et cetera, still looks fabulous. However, the story that a lot of people have not really realized yet is you're just now starting to see the build out of the local supply chains in Vietnam, of local Vietnamese companies that can help supply those FDI manufacturers with inputs for the products that they export. This is the same thing that happened in Singapore and Thailand. This is a story that's been repeated over and over. I think that's going to be one of the biggest economic drivers for this country over the next 5 to 10 years. So far, not a lot of people are talking about that, but I think this is a very important thing for people to know about.
Thanks, Mike. A question from the West Country here in England. What is the current political position? Is it stable and sustainable?
Yeah, the current political system is stable. We at the beginning of 2020, Vietnam promoted the new leadership for the next 5 years. In terms of policy, we don't see a whole lot of changes in terms of the policy, particularly around economic policy, and in terms of promoting growth through FDI as well as FII. But I think the challenge for Vietnam in the next 5 years is that because they want to promote FDI and all the manufacturing coming to Vietnam, Vietnam will have to invest a lot more on the infrastructure front, as well as provide more trained labor, the labor force.
Thanks, Andy. Probably time for 2 more questions here. The first here, what exposure does the trust, the company, have to Belt and Road, and what opportunities and risks does this offer the Vietnam market?
The VOF in Vietnam, in large, I would say, is not exposed to the China Belt and Road Initiative. So at the moment, we don't see any sort of impact directly. I suppose on the indirect front, if folks are, like Mike was saying, if the United States is getting closer to China, to Vietnam, if the United States is getting close to Vietnam and manufacturing is migrating a lot of their businesses to Vietnam, we have to invest on infrastructure and the labor force.
And final question, does the team invest alongside the state in state-owned enterprises? And what are your views on that in Vietnam?
At the moment, we do not invest alongside the state and the state enterprises. We do look at SOEs or state-owned enterprises that are going through the equitization process. So we would invest directly into the state-owned enterprises that are going through the equitization or effectively privatization exercise. And as you know, the privatization activity was quite vibrant from 2005 to 2010. It has slowed down significantly over the last couple of years, but there's only about 2,000 or 3,000 companies left. The original list was about 14,000 to 15,000 SOEs. And I think in the next few years, the government will continue to equitize the remaining 2,000 to 3,000 large companies, if you will.
So, good day to you. Finsbury Growth and Income Trust is a concentrated stock portfolio. And my focus on this session is to discuss some of those stocks in the portfolio and the opportunities that we see for them. First, though, I hope you might permit me a brief preamble. And what I want to say as a preamble is this. Last week, I had my second jab. And I don't know if it's the Pfizer talking, but I have to say, I feel really quite stoked at the moment. I feel really quite energized about the much improved performance of the UK stock market in 2021. Right now, as we speak, and as I'm sure you're aware, the UK market is even outperforming NASDAQ in 2021. And long may that continue. How realistic is it to hope that the UK stock market might continue this renaissance? Well, I have to say, I do think that there is a credible case to argue that this long period of more or less dismal returns from the UK equity market, that has resulted in a systematic underperformance for UK stocks. But even so, having said that, I think that there is a far more important factor at work in 2021, or at least I hope there is. And that is, we wonder whether global investors are still underestimating a technology-driven upsurge in innovation across the UK corporate sector. Look, I'm sure you can see it as well as we can. You see it in new business formation, you see it in the IPOs, we see it in the investment actions of many of the companies that we're invested in across Finsbury. And if that's right, that this entrepreneurial corporate sector that we have in the UK really is in the throes of an upsurge in the effectiveness of its technology investment, then there is indeed every reason to hope that the UK stock market can go on being stronger for longer. Certainly my aspiration as a career-long UK equity manager. Okay, so that was my preamble. Now turning to Finsbury Growth and Income Trust, you can see our standard performance slide here. I don't want to dwell on it, except if you allow me just to highlight the fact that 2020 was a very significant year for me personally. It was the 20th year of my responsibility for FGT. And, that's quite some stint, 2 decades and counting. And I'm a little bit proud of that. And I'm also, without dwelling on this, I'm also reasonably content with the long-term track record. However, and being candid with you, and no point in not being candid, however, I am less than delighted by the more recent relative performance of Finsbury's NAV. Certainly over the last 6 or 7 months, there's been quite a sharp deterioration in our relative performance. You can't see it in the 2020 return because we did actually still outperform during calendar 2020. But once the vaccines were announced towards the back end of last year and through into 2021, we have lost ground. As you can see, through to the end of April, we're up 5, and the all shares, well, I'm pleased that the all shares gone up. The all shares up 10. So what's going on? 2 factors here. One structural, the other highly stock specific. And I am going to talk about both because, as I alluded to earlier, I also think there are opportunities in some of these recent price divergences. So first of all, our current structural issue. As is, I think, quite well understood, under my stewardship of Finsbury, we've always had big holdings in big, reliable, steadily compounding companies. Maybe even today, something like 40% of the NAV is made up of companies with those steady compounding characteristics. Now, that was quite a comfortable place to be during the bulk of 2020, but much less so right now, as other investors are looking either for recovery or, candidly, I have to admit, other investors are looking for more rapid growth businesses. And, you know, it may well be, at least temporarily, that our steady compounders are being today perceived as dull plodders. Now, listen, I might think that that's unfair. I do think it's a bit unfair. But I have to acknowledge, you know, when I look at our portfolio, I have to acknowledge that, you know, an important holding like RELX, which is a business where I have to say we still have very high hopes, high expectations for both business performance and share price, or a holding like Heineken as well, another, in our opinion, structurally advantaged company. Although RELX and Heineken share prices are up in 2021, they've not kept pace. They've not kept pace with the all share. And actually, our archetypal dull plodder, and another big holding for us, our archetypal dull plodder, Unilever. Now, that is actually down in 2021 year to date through to the end of April, down just around 3%. Now, I'm showing you this slide. And this is the slide I've worked with before with Unilever. And let me say, I totally acknowledge that this slide is purely historic. I'm not necessarily claiming there's any predictive power in this slide. But what I would say is that every time Unilever, as it is now, is going through a period of being out of favor with other investors, and indeed when these steady compounders are out of favor with other investors, I like to remind myself of just how formidable these companies can be by looking at this slide. So here is Unilever's dividend history as far back as the company can provide the data for. And, you know, it's a hell of an achievement to me, to us. It's an extraordinary achievement. Over half a century of rising real dividends. It's a very special achievement by that company. And, you know, be in no doubt that that dividend growth has also resulted in very, very marked and attractive capital performance as well. If you go back to 1988, which is as far as Bloomberg will take you, or take me anyway. If you go back to 1988, 33 years ago, Unilever's share price, just purely the share price, Unilever's share price is up 16-fold since then. And that compares to the FT All Share Index, which is just slightly more than quadrupled. Okay, so that is a huge differential, and you know, really is testament to the sort of returns that successful, steadily compounding companies can deliver for you. Will it continue? We understand, you know, other investors clearly have reservations about it, and in the final analysis, we can't know for sure. Maybe I will say this, though. At the end of April, Unilever reported its Q1 results, its first quarter results. They were better than expected. I believe the share price certainly rallied on those Q1 results. And just picking a few statistics out of that Q1 report, I just think it creates a more positive picture. Q1 to Q1, India was up 20%, revenues up 20%. China up double digits, so teens. Prestige cosmetics up 20%. Key brands of the future for Unilever, Ben & Jerry's ice cream up 30% quarter to quarter. Hellmann's mayonnaise, Magnum ice cream, Horlicks, nutrition drink, all up double digits. E-commerce revenues up 60% year over year, now 11% of the total, and Unilever argue that e-commerce revenues are incrementally margin improving for the company. So, actually there are some encouraging things going on within this formidable business. And I just want to make one other point about the first quarter and sort of extrapolate from this to some of the other compounders we own as well. Unilever announced a share buyback with those first quarter results, £3 billion of buyback. That's roughly 2.5% of the current market capitalization of Unilever. In addition, Unilever also, I admit, nudged up its first quarterly dividend, only a 2.7% dividend increase. But that's on top of the running dividend yield at today's price of 3.5%. What that means notionally, nothing ever works out exactly, but what it means notionally, if you add those three numbers together, let's say 2.5 plus 2.5 plus 3.5, notionally there could be something like an 8 to 9% per annum return out of this asset, even with no share price re-rating. Now, similarly, another of these, I'm going to call them steady compounders that we own within Finsbury, similarly, just think about Mondelez, which we inherited from our holding in Cadbury. Mondelez has a dividend yield today of 2%. That's lower than Unilever, but that's because it's in structurally more rapidly growing categories, arguably. Certainly, Mondelez's recent dividend growth has been faster than Unilever's. Mondelez's dividends were up over 10% last year, and the first quarter dividend also up 10%. And Mondelez, too, is in the process of buying back its own shares in 2021. Maybe 4% of Mondelez's market cap to be retired this year. Again, you add those numbers up and maybe there's an expectation that Mondelez's equity might return low double digits, maybe even mid-teens returns. And listen, just to show that that's not complete pie in the sky, consider that last week Mondelez's share price actually hit its all-time high, and that the stock is up significantly more than 50% since the start of 2019. So I suppose what I'm saying is we understand, and we know that you understand, that these companies are not Coinbase. That they don't have those characteristics, and yet there still seems to be plenty of justification for the expectation that they can continue to grind out perfectly acceptable returns, as they've done for decades. Okay, moving on to our stock specific problem in 2021. That's the London Stock Exchange. I'm showing you the long-term share price of the LSE here, just to give me a happier backdrop. But as is well known, the LSE has suffered a severe bout of profit taking so far in 2021. At the end of April, it was down the best part of 20%. And given that that was our biggest holding at the start of the year, that has been painful, both in absolute and relative terms. Now, look, I don't know how relevant it is for me to hold forth on our aspirations for the LSE from here. I don't know how relevant it is, but I'm going to do it anyway. I'm going to do it because this remains an important holding within Finsbury. Also because, to me, it's become an important company within the context of the UK stock market in general. Also, it might be a buying opportunity. Let's hope so. So, this transaction with Refinitiv, I mean, yes, it is a bold deal. It is, to use the cliche, it is a transformative deal. And no question, bold, transformative deals bring execution risk. And the fact is, neither me nor the company itself can offer absolute certainty that that execution will be carried off flawlessly, let alone successfully. But nonetheless, we think it's so important not to lose track of what's been created by this combination. It's a truly substantive company, the LSE Group. It's a £40 billion market capitalization. It's become the world's number 2 financial data and analytics business. Recurring revenues are now up to 70% or more of the total, and those are sticky revenues. The company is targeting 50% operating margins, and there seems to us to be credible aspirations for an acceleration in revenue growth from the historic combined sort of 4 to 5% to 5 to 7% over the next couple of years. In short, the London Stock Exchange Group has turned into exactly the type of business that UK equity investors like me have been bemoaning the shortage of over the last 3 or 4 years of poor or disappointing UK equity market performance. Does that make sense? The LSE Group in its current form, that's quite a rare company by global standards. It's a very rare company, a globally substantive data and analytics business. It's a very rare company in the context of the UK stock market. There's RELX. I've already mentioned we own a big holding in RELX, and yep, let's hope that one fulfills its potential. Experian is arguably another, and we have a growing holding currently in Experian. But after that, not many more truly substantive businesses in this category. So look, the share price kissed £100, just under £100 when the deal closed. You can buy it today at 72 or slightly less. That's a meaningful haircut. Let's hope it is a buying opportunity. Let's hope it is, because we are certainly adding to our holdings. I've spoken too long about the LSE, but I'm going to kind of summarize on it to segue into my next point. Investors have been asking politely, perhaps in some cases demanding, the companies that they're invested in. They've been asking them to politely to ensure that they emerge from the pandemic stronger than when they went into it, and with superior growth prospects from when they went into it. And absolutely, I would argue that that's what the LSE has done. But also, I would argue that there are many holdings across Finsbury Growth and Income Trust for who that is also true. And on this next slide, I just want to highlight a few of those that are working for us in 2021. So there are two columns of stocks on this slide. On the right hand, you can see the names that have not worked so far, anyway, in 2021. The names I've already discussed. On the left-hand side of the column, though, some of the positions that have outperformed the FT All Share Index through to the end of April. And I'm just going to pick out a few names here. Burberry is, in my opinion, a very important holding for Finsbury. To us, there is a lot of latent value within this investment. Now, I'm thrilled it's up 15% year to date. Burberry got absolutely clobbered last year, and actually, from its low point of last year, the shares are up now nearly 70%, I think, from the low. But just consider this. From its nadir in 2008, over the next 5 years, so between the bottom of the financial crisis in 2008 and 2013, over that period, Burberry's share price went up 7 times, 7-fold increase as confidence returned and the global economy healed itself. Now, will Burberry do that again? I can dream. But I do think Burberry is a company that has not received credit from investors for the expensive investments that the current management team have made over the last 3 years in shifting Burberry's product and image higher up the luxury curve. And I guess our hope is that that investment begins to pay off over the next 2-3 years, and that it pays off at a time when possibly the world may be experiencing a kind of roaring 20s. Yeah, we've all heard of this idea of the COVID recovery being a period of roaring consumer consumption. Actually, I don't think it's anything to do with COVID. If there is going to be a roaring 20s, it'll be because new technology is creating new wealth, and that new wealth is being spent on luxury products and services. Let's hope Burberry's leather goods and outerwear get at least their fair share of that. Now, another company that's likely to be a beneficiary of any possible roaring 20s, another company that could be a beneficiary is Diageo. Diageo had a tough year last year. Again, I'm delighted to see the share price doing better in 2021. It's our biggest holding in Finsbury right now. Diageo is part of that 40% I mentioned earlier of steady compounders. And again, Diageo has done well over time. I'm just going to remind you, over the last 20 years, Diageo's share price has more than quadrupled, while the FT All Share Index, I regret to inform you, because it just emphasizes what a tough period this has been, the All Share is barely up 40% in capital terms over that same period. So Diageo has done much, much better than our benchmark. But we've got every reason, I think, to hope that Diageo does even better over the next 20 years than the preceding couple of decades. And that's because we think there are good grounds to believe that these increasingly apparent trends, secular trends, of people around the world drinking less alcohol, but drinking higher quality gear, and in particular, drinking more premium spirits, that secular trend is accelerating. And obviously it plays absolutely to Diageo's strengths. Just as with some of those other compounders, Diageo's also resuscitated a share buyback. And to us, that's nice to see. I think it's really nice to see the board of Diageo sanctioning that buyback, kind of confirming our view about the strategic value in the equity currently. Looking at some of those other names on the left-hand side of this slide, we do have a couple of companies where there's been heavy investment in digital technology. Nice to see some payback for those shares. Daily Mail and General Trust has been a nice contributor for us this year. That stake it has in Kazoo is purportedly, if all goes well, worth nearly half DMGT's market capitalization. If that's right, then this trust structure is undervalued. The Daily Mail General Trust structure is undervalued to us. Even Sage, which was, I must admit, a very disappointing holding for us last year, has perked up in 2021, confirmed by its results last week. Its cloud native products also growing strongly. And just kind of returning to my opening proposition, I think it's encouraging, I'm encouraged anyway, to see the three asset management investments that we have within Finsbury, to see them all outperforming through to the end of April. That's Hargreaves Lansdown, Rathbones and Schroders. And, I think that does reflect improving business confidence in the UK, and it definitely reflects improving stock market performance by the UK. And if both of those can continue, then we've got to be hopeful. We've got to be hopeful that those companies can carry on re-rating. Okay, I think I'm almost at the end of my prepared comments. Thank you for listening to me. I think I wanted to conclude by acknowledging an article written by Lawrence Burns of Baillie Gifford in the Financial Times earlier this year. It's, the whole article is so stimulating. During the course of the article, there was a quote, a phrase that really resonated with us. He said something like, "Our clients always ask us about our sell discipline, but they rarely ask us about our hold discipline. And yeah, I thought that that was insightful, true, and important, because holding on to companies with winning characteristics is sometimes difficult because they don't always perform well all of the time. Of course, BG are, past masters at that. But, as I hope I've conveyed, within Finsbury's portfolio, that there are companies with winning characteristics, and yeah, we're certainly intending to carry on holding. Anyway, with that, thank you very much, and now happy to take any questions you may have.
Thank you, Nick, for the presentation. We have a series of questions now from investors, the first of which relates to the beverage companies. Almost a quarter of the trust is made up of beverage companies. Are you comfortable with this level of exposure to one industry?
I mean, evidently, we are comfortable. I am comfortable with that exposure. I sometimes wish that it was more than that. Of course, it's quite a diverse collection of beverage businesses that we have here. From premium spirits, through to national soft drink champions. I think what I would say is that right at the start of Linsell Train Limited, Mike and I said to ourselves, we must invest the capital that is entrusted to us. We should invest that as though it was our own. So to invest it with the same sort of time horizon that we might have for our families, and maybe with the same sort of conservatism that one might have thinking about one's family wealth. And for decades we have observed how enduring fortunes, enduring family fortunes have been built around the ownership of beloved and resonant beverage brands. And it's just always seemed to us to be an industry where the predictability of the brands and the profitability of the brands is so high that they merit absolutely a core commitment. I think over and above just that desire to allocate really structural long-term capital to enduring businesses, I think what's further been reinforced to us over the last couple of decades is the extent to which beverage companies, particularly premium beverage companies, act as a proxy for wealth creation around the world. Everybody knows the emerging market story, the transition from drinking local beverages to drinking international ones, and that emerging market story, I think, is still attractive for a company like Heineken, for instance. But I think what's so interesting to us is seeing how the creation of new wealth, technology-driven new wealth, is encouraging this incredible acceleration in the consumption of premium spirits, and that's playing absolutely into the hands of Diageo and the investment that we have in Remy Cointreau. Both businesses performing extremely well, and the share prices as well. I'm pleased to say. So, sorry, long-winded answer, but yeah, I do feel pretty comfortable with that allocation.
Thanks, Nick. That's quite a nice route into the second question, which is, can you expand more on the idea that new technology is creating new wealth? Do you mean company formation, unicorns, etc., or asset based wealth, such as crypto?
I mean the market capitalizations of emergent companies, of dominant companies in this space. Yeah, there's just more collateral, more equity collateral that's been created. And you're right as well. The new business formation, IPOs, it is creating new wealth, and yeah, we can see the benefits of that in investing in the successful emergent companies, but also finding ways to participate in that new wealth creation. Yeah, via the savings intermediaries, the capital markets intermediaries, the luxury goods businesses as well. So yeah, this idea of the Roaring Twenties. As I said, a simplistic way to think about that is just a reopening trade as we emerge from what we've emerged from, and there is an effect there. I was amused to, well, I'm not sure amused, but I was intrigued to see Heineken being forced to acknowledge that it was running out of beer in the UK, or the beer that it supplies to its pubs. So strong has that reopening trade been over the last six weeks in the UK. Apparently, you can't get your hands on Amstel or Moretti at the moment in the UK. But that's a relatively short-lived phenomenon. I think if there is going to be a Roaring Twenties, it's going to be based around a continuation of this extraordinary trend of wealth creation by new industries.
Thank you. With the benefit of hindsight, do you feel that you missed any opportunities during the weakness in 2020?
Well, of course, because hindsight is such a wonderful thing. I felt that by our standards, we were quite active last year. We did initiate 2 new holdings, Experian and Fevertree, and certainly the Fevertree holding we initiated in a timely way. Experian's been less successful shorter term, but that creates an opportunity for us to add more to that. As I said earlier, I think a very rare UK company that is, truly well advantaged from a global perspective in data and analytics. Should we have bought more new holdings? I'm not sure. I did feel, and still to an extent do feel, that there were plenty of opportunities to add to existing portfolio holdings during the middle of last year at very, very attractive prices. Not least some of those other beverage businesses. We did buy more Diageo into weakness last year. Again, a stock I mentioned in the comments earlier, Burberry. A lot of the available marginal capital went into Burberry at very, very depressed prices last year, and of course, I'm pleased with the bounce in that company's price since its nadir last year. But again, to repeat myself, the latent value in the revenue base of Burberry as it gets towards the end of this transition from lower end luxury to genuinely luxury sales, the valuation that you could ascribe to Burberry's revenues today, to us, is much higher than would have been the case 2 or 3 years ago. And yeah, let's hope that there is a roaring 20s, and that taking advantage of that opportunity last year was a timely thing to do. I think, when I look back at 2020 and to a degree into 2021, I'm not sure this is a regret, and it's not really a disappointment with the company, because it's pointless, but things are what they are. But Relex, again, I know I mentioned Relex, 90%, maybe more than 90% of Relex's business today seems to us to be so wonderfully positioned for the bull market trends that we have seen, and I suspect we're going to continue to see around the world. Just such a shame that that exhibitions division has been a drag on both earnings and understandably sentiment for that share price as well. Again, looking forwards, got to hope that as that exhibitions business stabilizes and perhaps accelerates next year, we get a big catch up and a re-rating in Relex. That would be very, very welcome.
Thanks. We've probably got time for 2 to 3 further questions. Next one is, how is ESG integrated into your analysis and portfolio construction processes?
Well, it's a great question. And it's a great question to ask me, because I'm the chair of Linsell Trains Limited's relatively newly constituted committee. So I'm absolutely the person to ask that question. I would say that ESG is absolutely central and intrinsic to the way that we think about allocating capital. We are known as very, very long-term strategic buy and hold investors, and we are, and we will continue to be. But when you consider allocating capital in the way that we do, which is on a decade or more than a decade time horizon, it's so crucial that we're invested in companies that meet and are ahead of consumer and societal changes in attitude or behaviors. So, we've always encouraged the companies that we're invested in to not just think about those issues, but look to preempt and respond to those issues. And without being overly complacent, we congratulate the majority of the companies that we're invested in for their farsightedness. Slightly changing the subject here, but it's still intrinsic, of course. In addition to the time horizons that we have, which necessitate thinking about ESG issues, the preferences that we have for industry choices, by and large, means that our portfolios just have lower capital intensity than the benchmarks that we're measured against. And that's a useful starting point for us. We understand that we've got to continue holding the companies to task, and our own business. But we start from a position where there's much more intellectual capital on average across our portfolios than physical capital, and that's a good place to be. We are, my colleagues and I, we're in the middle of increasingly systematizing these ESG questions that we're asking all of the companies that we're invested in. I think we can do more there to ensure that we know the half dozen critical issues for each company, and that we can pursue those at each time that we engage. So there's more to be done, but yeah, I think we start from quite a strong position.
Great. Probably the final question now. The compounding characteristics that you elegantly laid out for the stocks you own may already be reflected in the price. How do you consider the price you are willing to pay?
There is a, as is evident, and as I've just reiterated, there is a tendency in the way that we think about running money to just want to let the compounding continue and not to fuss and fret overly about short-term valuations. Having said that, there are two rules of thumb that we use. One of which is a kind of moving rule of thumb, which is we follow very, very closely transactions that take place between companies for the sorts of assets or brands that we're invested in. So we're constantly looking for a validation that our conception of value is being supported by transactions between companies. So I don't know. This is a relatively trivial example, but earlier this year, Planters, the nut business, peanuts, salted peanuts, that business was sold by Kraft Heinz for around, I think, 3.5 times its annual revenues. But that's a very useful marker for us, looking at parts of, I don't know, Mondelez's business or parts of Unilever's business to assess whether or not their values may be getting stretched. And evidently, because we still own them, we don't think so. The other rule of thumb that we've worked on is that on a post hoc basis, multiple decade post hoc basis, you can work out that those businesses that are capable of compounding reliably over many decades ought, in inverted commas, to be worth over 30 times earnings. In other words, earnings yields of around 3. And I guess that's a sort of backstop that we might have in our minds constantly to help us judge whether or not the other investors' appreciation is full or otherwise.
Thanks, Nick. Appreciated. I'm going to squeeze one more in. How is the portfolio positioned for rising inflation's higher interest rates, as we said today?
Who's saying there's going to be higher inflation and higher interest rates? I'm not saying there won't be, but just to reiterate, in my experience, certainly my experience, attempting to add value to equity portfolios by considering possible shifts in the macro environment, it's not added great value, certainly from my from my experience. I'd say that our portfolio, all of our portfolios, there's a combination of businesses with strong pricing power. I'd evidence these beverage companies, particularly the spirits companies. Just in April, it looks as though there were 9% price increases across the US spirits industry year on year. We've got definitely companies with pricing power. We've got companies, particularly in the financial sector, that are arguably beneficiaries of rising interest rates, partly because they earn an interest rate margin, partly because the volatility around interest rates drives transactions. And I'd also say, in the end, if we've got our stock selection right, that actually what we're invested in are businesses with secular growth. And if we're right about that, that should take care of interest rate and inflation volatility.